I am JB Bryan, President and Chief Investment Officer at JB Bryan Financial Group, the home of AfroEconomics. It's tax attack and attack of the pollen on my throat as well. Look, I remember last year when I did this, and some of you were like, oh my goodness, JB, I feel so sorry for you. I think I'm better than last year. I know, and I'm getting little chats right now from people in the webinar. Those of you who I cannot communicate with right now because you didn't register for the webinar, please make sure you do. Go to the AfroEconomics.com, click on events, and register. For this, also look out on Monday night, it's Women in Wealth. We are doing a series. Next month, it is men and their money. Yes, AfroEconomics is all about the complete family. Thank you. So tonight, I want us to discuss tax tips. It's a tax attack. Tax season for AfroEconomics is all year long. So we're in a consistent tax phase. Yes, because I want us to be, by the time that you're doing your taxes, it's too late to try to correct what you should have been doing all year. So I want to talk about what you should be doing all year long. I'm going to continue to yell to make sure that my voice projects to some degree. Make sure that you let me know if I do, like, JB, stop yelling. I will probably still not stop yelling, but you can tell me that. Thank you for bearing with me. So let's look at these tips, and I'm gonna make it as quick and as concise as possible. I have my notes. So we're talking about the first one, and I have discussed this a little bit. Updating your U4 form. Now, this is about how to lower your tax bill. Now, updating your U4 form is not going to really lower the bill, but it will at least allow you to pay the proper amount during the year. So if you pay the proper amount during the year, you won't owe at the end of the year. Because a big complaint this year was everybody saying, I owe da-da-da-da-da amount of money. I owe this, oh my God, oh Trump. Trump got me owing all this money. Oh, because of that new tax. Well, what happened was employers changed their withholding on you. And they came out, so what happened was they changed the withholding. They stopped withholding as much. And some people have multiple households, most of you have multiple incomes coming into the house. So because of that, you were not withholding enough during the year. That's it. Some changes happened, but for the overwhelming bulk of you, only thing that happened is that you're not withholding enough. So we need to update your W-4 form. There is a withholding calculator at irs.gov. Hey, this is some powerful stuff I'm telling you right now. Go to irs.gov, withholding calculator, and you can make sure that you calculate approximately what you should be withholding. If you're not withholding that, you need to do a new W-4 form, W-4, Google that, and then update that, give it to your employer, and you're good to go. And they will adjust what you're paying during the year. Yes, that's it. That will lower your tax bill. Check this out. I know you've heard this 1,000 times, I hope, from me, at least 2,000. But you have to participate in your workplace retirement account. 401k, TSP, 457, 403b, whatever the tax code is for your job, because different types of entities have a different tax code. 401ks for corporate, 403b, nonprofit, 457, state municipalities. So, or cities, so everybody may have a different way of saying it, but you want to participate in the workplace plans so that you can contribute as much as possible, and it will reduce your taxable income, because we all want to save. But if you save after you pay taxes, it costs you more to save, because this way you're saving more and it's not hurting your wallet as much because you're saving before you pay the taxes. And if you're 50 and over, you can save even more than a person that's under 50 years old. So the 2019 maximum for 401k contribution is $19,500, and an additional $6,000 can be contributed for people 50 and over. Hey, right? Any questions on that? So definitely make sure you don't hesitate to ask me any questions as we go along. As I'm talking, I'm going to eventually go back into your side so I can see your questions instead of like going back and forth. I have a Q&A. Oh, it's same. I need to take this one out. Well, a participant said, I'm not trying to pay any taxes. And I know that's right. So I'm going to take that out. I agree. And what we're doing is reducing that taxable income through participating in your work plan. And I know that you are, and that's fabulous. And make sure that every working person in your household, you're doing joint tax returns. Make sure that your spouse is also contributing to their work retirement plan. And they might say, oh, I just don't make enough. I can't do that. Well, generally, and more often than not, they're giving away money because many employers allow you to offer you a match up to a certain percentage. And of course, their match is not your maximum. You can put up to $19,000, but they may be only matching half of that. But you're going to get $19,000 plus what they're putting in. Too much money is being left on the table. And how about, even though you have a work plan, you still can reduce your tax bill by participating in an IRA? Yes, you can. If you qualify for a full tax deduction, you can qualify for a full tax deduction of your IRA contribution, even if you're in a work plan. If you have income of $103,000 or less when you're filing jointly, or single of $64,000. So you could be going with your bad self, putting in $19,000 in your work plan and still being able to, you can still contribute to your IRA also, because you're just a serious saver. Do that, do it. So, and for 2019, the maximum deductible contribution to an IRA is $6,000. If you're 50 and over, you can also add $1,000 to that. So that's a tax deduction. Of course, the work plan is fabulous because you don't even have to worry to write it off later. It's done automatically for you, so it reduces the taxable income. Yes. Have you ever heard of a health savings account or like the flexible spending account? Well, those are actually the health spending account. Let's focus on that. That in addition to having the 401ks and the IRAs, the health savings account is an account where you can contribute pre-tax contributions in order to help pay the cost of your healthcare costs, because so many healthcare plans have high deductibles now. So what you can actually contribute to the health savings account. And I don't know, look, raise your hand, let me see you. If you work somewhere that has the HSA, the health savings account, for 2019, single individuals are eligible to contribute to the HSA if they qualify for having a high deductible health plan. So that, like, the out of pocket would be like $67.50 You have to have like, you know, a high amount for your out-of-pocket maximum. But it says with a deductible of at least $1,350, so that would be deductible, and a maximum out-of-pocket limit of $6,750, or of course higher, then that's considered a high a health savings account. You're eligible for that. It's considered high deductible health plan. So and then there's different limits, of course, for a family. If you're in a family health plan, then it's $2,700 for the deductible and $13,500 for the out-of-pocket spending limit. So definitely investigate the health savings account, but just know the maximum contribution for individuals is $3,500, and for families it's $7,000. So you can withdraw the money anytime, and you won't pay taxes, and the money is invested during this time, and you won't pay money on the withdrawals as long as the money is used for health care. But if you withdraw the money and it's not for health care, then you will pay a 20% tax penalty. They ain't playing. And if you have a balance in the account after you turn 65, then you'll pay ordinary taxes on the money, but it doesn't, it says you're put on the, it says if you will pay ordinary taxes on it unless you use it for healthcare. So these are, this of course, I'm going to give you as much details as possible within this very limited amount of time. So definitely just use this for tips so that you just know I have to investigate this farther if it sounds like something that can help you if you have a lot of healthcare expenses, and I hope that you don't. But it is indeed a way to reduce your tax bill. Yes, it is. So let's go on to, what about this? Here we're talking about ways to reduce your tax bill right now, because every day is tax season in AfroEconomics. So we're keeping receipts and documents, keeping all receipts and documents that can help you save on your taxes. That's things like your receipts for medical care, your receipts for charitable contributions that you make, your receipts for property tax payments, local tax payments, business expenses, keep them, tuition that you pay, educational expenditures, make sure that you keep those receipts. Even if you think, why am I keeping this receipt? Keep it anyway. Keep everything that you think could possibly be deductible. And if you don't use it, you can throw it out at the end of the year. It's better to have it and not need it than to need it and not have it, right? And then, so make sure that you are doing that. What's you talking about? Let me make sure. Oh my goodness, I apologize. That's right. Matching is indeed free money. Thank you. Yes, indeed. Ms. Jones said, how does this apply to getting 2 checks per month, pension via retirement and Social Security? The challenge there with getting multiple sources of income, very good question, because you need to make sure that you're withholding the proper amount of taxes on all of your sources of income. Now, I had a member come in today and we were doing our quarterly meeting, and I was like, how did your taxes turn out? And she was like, oh my goodness, I didn't withhold taxes on anything. Nothing on pension, nothing on Social Security, nothing on IRA withdrawals. And I was like, I noticed that last year you didn't want to withhold anything. I said, that's why I asked that question. How did it turn out? And she said, all right, you got me. I don't want to do that this time. So for this year, we set up to withhold the taxes. And I was like, I think it's better to have the money and pay them on time than to really overpay them and they're sending you your money back without interest, because you keep your money. So, the good thing is that we planned for making sure that she had extra money to pay anything that may be due. Do you still lose the balance on your HSA at the end of the calendar year? No, you don't. You can go all the way to 65 years old with a balance that you created in your 30s and then get to 65 and be able to, draw it out. And so, definitely, and you can draw it out anytime, of course, for medical expenses. But at 65 is basically, it's yours, and it will accumulate. It's more of an investment than that flexible spending account. You're right. So it says use the big yellow envelopes and label them with categories of receipts and documents. That's right. Big. Why do they have to be big and yellow? Why do they have to be the big yellow envelopes? Huh? That's right. But he said whatever color you want, but organize those receipts. You're right. You are right on point. The principle of AfroEconomics, organization and planning. Keep those receipts and keep them handy. Very good points, y'all. Let me keep it rolling. Here's another tax tip for right now. Making the right choices of itemizing or claiming the standard deduction. When you file your taxes, you have two choices. You can either claim a standard deduction or you can itemize and claim deductions for specific spending that you do, such as taking the deductions for taxes and mortgage insurance. The standard deduction for this year is $12,200. Last year, 2018, it was $12,000 for singles. And for married filing jointly, $24,400, up $400. So if you're married filing jointly, and if you're head of household like I am, that's $18,350. And if the value of your itemized deductions doesn't exceed the value of your standard deduction, then you claim the standard deduction. I bet to some people that sounds absolutely crazy. And I just thank God for being able to realize that that makes perfect sense to me. And you're like, what in the world are you talking about? But we have to get familiar with things that you can write off as itemized deductions. And that's why when you're going to your tax preparer, they'll ask you things like, do you have mortgage interest? And they'll say yes. So and you have to be very aware of this, you need to know if you have enough deductions to itemize or not, because they will charge you for doing the itemization calculation, even though they can look at it and tell, oh, you have $3,000 in mortgage interest and $2,000 of charitable contributions. And that's pretty much all the itemized things that you can do. Oh, and then a couple $100 of state taxes or whatever. Okay, what? So that totals $6,500 in itemized. Are you going to take $6,500 or are you going to take that standard deduction for your household of $24,400? Of course, you're going to take the $24,400. So when you go into the tax preparer, you should say, yes, I do have a home mortgage, but it doesn't exceed the $24,000 all of our itemized deductions. So we're not going to be able to do that. So do not charge me for calculating that I don't qualify for itemized deductions. So be very aware of that. And then, but knowing that the difference, making the right choice between the itemized and the standard deduction can definitely help you a lot. You got to know it. Bundling your deductions, another serious tax tip. Say, for example, if you were given $5,000 a year to charities, and that's the only deduction that you have for itemizing, then if you take that $5,000 and you save it in a savings account, and then the next year you have $5,000 that you want to give to charity. And then the next year you have 5,000. Well, it might take you 3 years, but if you're single, by that third year, you have 15,000 in itemized deductions, which gives you an additional it gives you more itemized deductions than the standard deduction of by then maybe 12,600, for example. So you have an additional 3,000 or so in tax deduction because you bundled your giving together. So that's real. I don't know if you've ever seen, I did a CBS interview about the charitable giving, and I talked about bundling. You know, let's also, another tip, claim all of your dependents. If you have people that, of course, it was easy, you're going to automatically claim your kids. But how about the people that are just living with you? It could be an aging parent or a roommate that you are basically taking care of all of their living expenses, or you have a family member that has a friend that's been staying in your home, freeloading off you. Well, you need to look at the IRS requirements for how you can write them off as a dependent and recognize them as a dependent, no matter how grown they are. If they qualify as an IRS dependent, according to the requirements, then you write them off and make sure you let them know. Well, I guess you have to let them know because you're gonna need their social and everything. But don't just sit there and take care of people that are not claiming anything. They're not even doing a tax return, and you can be benefiting because you are taking care of them. And then an additional, claiming all your credits, claiming all of your tax credit. These are the ones that I want you to check out. Like, say you have a $5,000 tax bill. Well, tax credits reduce that tax bill. When it's a tax credit, you know, that it's not, you have to actually have a tax liability in order to take advantage of the tax credit. So if you take a 1,000 deduction, I don't want to say this. So if you have a $1,000 tax credit and the credit reduces your tax bill by that full $1,000. If you previously owed $5,000 in taxes, because of that tax credit, you will only owe $4,000 in taxes. So there's a child tax credit, there's a credit for other dependents, the child and dependent care credit, an earned income tax credit, a saver's credit, the American Opportunity Tax Credit, the Lifetime Learning Credit, the Federal Adoption Tax Credit, and the Plug-in Electrical Vehicle Tax Credit. So make sure you check out, just do Google tax credits and make sure that if there's anything that's applicable that can help you, let's discuss it during your quarterly meeting or get the details or talk to your tax preparer about it. Claiming all of your deductions. I kind of talked about that in the itemization. And but remember these, there's some key deductions to remember. Your deductions for retirement plan contributions, the deductions for the HSA, that health savings account contributions, deductions for contributions to flexible spending accounts, deductions for dependent care, deductions for student loan interest, deductions for investment loss, deductions for mortgage interest, a deduction for charitable contributions, deductions for qualifying medical expenses, and there's deductions for state income tax or state sales tax, you know, which just check out which one applies to you. Be very aware of these deductions. We got to do it. We got to check it out all year long. Another key tip is to join AfroEconomics as a full member. If you're not ready to be a full member, make sure you do the no excuse membership. But if you are a full member, I am pleading with you to make sure that we meet at minimum once a quarter via phone, Zoom, in person, New York, DC, Virginia. I'm do everything I can to make myself available. I even do meetings in Bowie. So, let's make sure. I know that we're all very busy, but I am only busy taking care of you. Know that. So help me, help you. Let's stay on that. Let's continue to make sure that we are financially prudent throughout the year, not end of the year, because by the time you're doing your tax return next year, that's way too late. So I'm going to continue to ride this home. I have this fascination and almost obsession with taxes. I guess you can tell. I double majored in accounting and finance. I really. So I'm just like, I really want to get deep into this. I'm going to start as soon as my child gets into college. You're going to be hearing me talking about taking tax law classes, because this is it. We got to pay it. So the more knowledge that we have about these tax rules, the more command we will have over how to be profitable business owners with our taxes. As we hear often, everybody complaining about Donald Trump not having to pay taxes. That man has a full staff of people making sure that he maximizes these tax laws to his full benefit. Full benefit. He probably spends as much on the people whose job is to avoid it as it would be if he had to pay the taxes, because paying them is a business expense. He can write that off. He said, well, I'd rather pay y'all than pay taxes, I guess. I don't know, but I ain't mad at him. I ain't never gonna be mad at nobody by following the rules and living by the law that they've set up for us. The bad thing is that we don't do it often enough. And that's what AfroEconomics is about. Us learning and me helping you maximize all of the opportunities that are available to us on this planet. We're going to do this thing. Thank you. I appreciate you all so much. Thank you. Whoa, let me check my comments. Do you lose? No, we got that one. Use and envelopes, I got that. What about those rare categories on the tax form for tax credits, the research and innovation credits? Yes, let's do that. I have no idea, but I want us to get the research and innovation credits. And I don't think it's just for businesses. That sounds like it would be a business credit that would go to businesses, but maybe even a personal person who is doing something, I guess they have to have a Schedule C. So it's probably more of a business tax credit, and you can help me on that. But I'll definitely look at how the tax laws are set up, to help us be smart. They're set up for you to be smart. They're set up for you to enterprise. Think about, like, you buy a stock, you're helping the business, you're helping the American economy. Even if that stock is not in a retirement account, that stock could triple in value. You do not have to pay taxes on that capital gain. You can die. Your child will inherit that stock at the market price. Nobody has paid any taxes on that capital gain. Your child could keep that stock and it quadruple in value, and then they pass it on at that higher price. And that's the new market value. And they're inheriting it at the market value. It is structured for us to help build the economy. It is structured for you to save for yourself. It is structured to help you do that. To reduce the 401k is set up because Social Security does not want people, all of us, to be broke and depending totally on Social Security, because they know they're pushing out the age on it, pushing out the age before the age in which most of us will be able to get it is like 67 for just full benefits. And then 70, I want everyone to be healthy and to be mad because they have to start getting their Social Security because y'all got so much money. You got so many other sources of income. That's the goal for everybody that's participating right here. You know, that is like, whoa, I don't even need that. So I'm just putting it off. And then the government say, you have to start taking your Social Security now. Won't that be a great problem? And I have clients that have that challenge. Yes. So that's what we talked about last week in our members only meeting about waiting for full benefits and things like that. So please participate more into the members only meeting. Even those with the no excuse free membership, you are privy to the members only meetings. So take advantage of that empowerment. The difference is the amount of time that we spend specifically on your goals when you're a full member. I hope that this discussion has helped. I'm going to, and Dr. Williams said the big yellow envelopes are magical and those are the ones to use. All right, he's standing by the big yellow envelopes. How about that, Delia? He's not giving up. I say big white envelopes are just as good, but go with the big white. Go with the big yellow. I'm with it. I believe you. I believe you. Yes, indeed. Because he said it, and they're magical. And I'm getting me some big yellow envelopes tomorrow. In summary, update your W-4 forms. Max out your 401k. Max out your TSP. Max out your 403b. Max out your work retirement plan. Max out your IRA. Contribute to a health savings account, a good tip if it's available. Keep receipts and documents that can save you, receipts like medical care, charitable contributions, property taxes. Make the right choice on itemizing or standard deduction and get a better idea of what is itemization. Bundle your deductions, bundle them together so they can help you more, do more in 1 year so it can help you get past that standard deduction. Claim all of your dependents, all of it. Anybody dependent on you, your mom, your dad, your cousin that's living in your house, wherever, they're dependent and you've been taking care of them according to the IRS requirements for a dependent, claim them. Claim all of the credits that are available to you, child tax credit, savers credit, America's Opportunity Tax Credit, get all of them. Even on the research and innovation tax credit, check it out. Yes, indeed. Thanks, Dr. Williams. Claim all of your deductions. Deductions are HSAs, deductions for retirement plans, deductions for flexible spending, deduction for dependent care, deduction for student loan interest, deduction for investment losses, deductions for mortgage interest, deductions. Check out all of the deductions, and having a tax professional should help you, especially if you have a complicated tax situation. And a big part of our tax planning and AfroEconomics membership, when we're reviewing last year's tax return, it really helps me so that when you go into talk with your tax professional that's preparing your taxes, you are very organized, and we've set up a process for your tax saving success all year long. Be encouraged. I appreciate you. Thank you for your time. I appreciate y'all so much. Email me. How you doing, Maurice? Terrence? Victoria? Dr. Arundel? How are you doing, Mr. Scott? Ms. Wright? Mr. Oh, wow. Demetrius, good to see you. Hey, Barbara. Thank you so much. Thank you all so much. Thank you, Ms. Smith. Thank you, Andrea. Thank you to our callers. Thank you. And thank you for the yellow envelope tip, Dr. Williams. Thank you. Thank you. Thank you, Boss Man, Bozeman. Yes. Thank you. I appreciate y'all. Have a good one. All is well.